Chapter 3: The Stock Market Level in Early 1972. With a century-long conspection of stock price, earning, and dividends before our eyes, let us try to draw some conclusion about the level 900 for the DJIA and 100 for the S&P Composite Index in January 1972. In each of our former editions, we have discussed the level of the stock market at the time of the writing and endeavored to answer the question whether it was too high. For conservation purposes, the reader may find it informative to review the conclusion we reach on this early occasion. This is not entirely an excuses and in self-punishment. It will supply a sort of connecting tissue that link the various stage of the stock market in the past 20 years, and also a taken from life picture of the difficulties facing anyone who tries to reach an informed and crucial judgment of current market levels. Let us first reproduce a summary of the 1948, 1953, and 1959 analysis that we gave in the 1965 edition. In 1948, we applied conservation standard to the Dow Jones level 180 and found no difficulties in reaching the conclusion that it was not too high in relation to underlying value. When we approached this problem in the 1953, the average market level for what years had reached 275, a gain of over 50% in 5 years. We ask ourselves the same question, namely, whether in our opinion the level of 275, the Dow Jones Industrial, was or was not too high advance for sound investment. In the light of subsequent spectacular advance, it may seem strange to report that it was by no means easy for us to reach a definite conclusion as to abstractness of the 1953 levels. We did say positively enough that from the standpoint of the value indication, our chief investment guide, the conclusion about 1953 stock prices must be favorable, but we were concerned about the fact that in the 1953, the average had advanced for a longer period than in most bull market of the past, and that it is absolutely level of the historical high. Setting these factors against our favorable value judgment, we advise a cautious or a compromise policy. As it turned out, this was not a particularly brilliant counsel. A good prophet would have foreseen that the market level was due to advance in addition 100% in the next 5 years. Perhaps we should add in self-defense that few of any of those whose business was stock market forecasting, as ours not had any better inkling than we did of what lay ahead. At the beginning of 1959, we found the DJIA at the all-time high of 584. A lengthy analysis made from all points of view may be summarized in the following from page 59 of the 1959 edition. In sum, we feel compelled to express the conclusion that the present level of the stock price is a dangerous one. It may well be perilous because prices are already far too high, but even if this is not the case of the market, momentum is such an inability to carry it unjustified height. Frankly, we cannot imagine a market of the future in which there will never be any serious losses, and in which every title will be guarantee a large profit on his stock purchase. The caution we expressed in 1959 was somewhat better justified by the sequel than our corresponding attitude in the 1954. Yet it was far fully vindicated. The DJIA advanced to 685 in the 1961, then fell a little below our 584 level to 566 later in the year, advanced again to 735 in late 1961, and the decline to near panic to 536 in May 1962, showing a loss of 27% within the brief period of 6 months. At the same time, there was a far more serious shrinkage in the most popular growth stock, as evidenced by the striking fall of the indisputable leader, internationally business machine, from a high of 607 in December 1961 to a low of 300 in June. Oh my god. In June 1962. This period saw a complete debacle in a host of newly launched common stock of small enterprises, and the so-called hot issue, which had been offered to the public at a ridiculously high price, and then had been further pushed up by the needless speculation to level a little short of insane. Many of these lost 90% and more of the conquotion in just a few months. The collapse in the first half of the 1962 was disconcerting, it not disastrous to many self-acknowledged speculators, and perhaps the collapse in the first half of 1960, if not distrust so many self-acknowledged speculators, and perhaps too many more imprudent people who call themselves investor. But the tournament that came later that year was equally unsuspected by the financial community. The stock market average resumed their upward course, producing the following sequence. The recovery and new ascents of the common stock prices was indeed remarkable, and created a corresponding revision of the Wall Street sentiment. At the low level of June 1962, prediction had appeared prominently bearish, and after the partial recovery to the end of that year, they were mixed, luring to a skeptical side. But at the outset of 1964, the natural optimism of brokerage firm was against manifest. Nearly all the forecasts were on the bullish side, and they so continued through the 1964 advance. We then approached the task of the appraising November 1964 level of the stock market, 892 for the DJIA. After discussing it learnedly from Numbers Angel, we reached their three main conclusions. The first was that old standard of valuation appeared applicable. New standards have not yet been tested by time. The second was not that the investor must base his policy on the existence of the major uncertainties. The possibility compassed an extreme on one hand of a protracted and further advance in the market level, say about 50%, or to the 1350 for the DJIA, or on the other hand, of a largely unheralded collapse of the same magnitude, bring the average in the neighborhood of, say, 450. Page 63. The third was expressed in much more defined terms. We said, speaking bluntly, if the 1964 price level is not too high now, could we say that any price level is too high? And the chapter closed as follows. I'm gonna wait until it scrolls. What course to follow? Investors should not conclude that the 1964 market level is dangerously merely because they read it in this book. They must weigh our reasoning against the conscious reasoning that they will hear from most competent and experienced people in Wall Street. In the end, and each one must take his own decision and accept responsibility. Therefore, we suggest, however, if the investor is in doubt as to which course to pursue, he should choose the path of caution. The principle of investment, as set forth herein, would call for the following policy under 1964 condition in order of urgency. Number one, no borrowing to buy or hold securities. Number two, no increase in appropriation fund held in common stock. Number three, a reduction in common stock holding where needed to bring it down to a maximum of 50% of the total portfolio. The capital gains tax must be paid with good grace as possible, and the proceeds invested in the first quality bond were held as a saying deposit. This is slow. Investor who for some time have been following a bond of fine dollar cost average plan can in logic elect either to continue their periodic purchase and change or to suspend them until they feel the market level is no longer dangerous, which advised rather strongly against the nation of the new dollar averaging plan at the late 1964 level, since many investors would not have stand a mind to pursue such a scheme if the results soon after a nation should appear highly unfavorable. This time, we can say that our caution was vindicated. The DJIA advanced about 11% further to 995, but then fell irregularly to a low of 632 in 1970 and finished that year at 839. The same kind of debacle took place in the price of the hot issue, i.e., with the decline running as much as 90% as had happened in the 1961 to 1962 setback, and as pointed to their introduction, the whole financial picture appeared to have changed in the direction of less enthusiasm and greater doubts. A single fact may be summarized the story. The DJIA closed 1970 at a level lower than 6 years before the first time such a thing had happened since 1944. That were our effort to evaluate formal former stock market level. Is there anything our reader can learn from them? We consider the market level favorable for investment in 1948 and 1953, but too cautiously in the later year, dangerous in 1959 at 584 for DJIA and too high at 892 in the 1964. All these judgments can be defended even today by Ulrich's argument, but it is doubtful if they have been as useful as our more penetration counsel in favor of the consistent and controlled common stock policy. On the one hand, discouraging inventor to beat the market or to pick the winner on the others. Nonetheless, we think our reader may be desire some benefit for bringing new consideration of the level of the stock market. This time, as late as 1971, even if what we have to say will prove more interesting than particularly useful, or more indicated than conclusion, there is a fine passage near the beginning of the Aristotle ethics, then it goes, "It is the mark of an educated mind to expect that the amount of exactness which the nature of the particularly is subject admit. It is equally unreasonable to accept merely probable conclusion from the mathematician to demand strict demonstration from the orator. The work of financial analysts did fall somewhere in the middle between the mathematician of the orator. At the various time in 1971, the Dow Jones Industrial Average stood at the 892 level of November 1964. Then we considered it in our previous edition. But in the present satisfactional study, we have decided to use the price level and the related date for the Standard and Poor Composition Index, or S&P 500, because it is more comprehension and representative of the general market from the 30 stock DJIA. We shall concentrate on comparison of this material near the forward date of our former edition, namely the year end of 1948, 1953, 1958, and 1963, plus 1968. For the current price level, we shall take the convenient figure of 100, which was restricted at the various time for 1971 and early 1972. The salient data set forth in Table 323. For earning figure, we previous both last year's showing and the average 3-year calendar for 1971 divided, we use the last 12-month figure and for 1971 bond interest and the wholesale price of those August 1971. The 3-year prices earning ratio for the market was lower in the October 1971 than at the year end in 1963, and at 1968 it was about the same as in 1958, but much higher than in the early years of the long bull. So this is table 323. The bull market. This important indicator taken by itself could not be considered to indicate that the market was especially high in the January 1972. But when the interest yield on the high-grade bond is brought into the picture, the implication becomes much less favorable. The reader will note from our table that the ratio of stock return earnings to prices to bond return has grown worse. I'm gonna check. So the January 1972 figure was less favorable to stock by this creation than in any of the previous year examined. When dividing yield or compared with bond yield, we find that the relationship was completely was completely reserved between the 1948 and 1972. In the early years, stock yielded twice as much as bond. Now bond yield twice as much and more than stock. Our final judge Our final judgment is that the adverse change in the bond yield stock yield ratio fully offset the better price earning ratio for late 1971 based on the 3-year earning figure. Hence, our view of the early 1972 market level would be tended to be the same as it was some 7 years ago, that it is an attractive one from the standpoint of the conservation investment. This would apply to the most of the 1971 price range of the DJIA between, say, 800 and 950. And from the historical market swing, the 1971 picture would still appear to be one of the irregular recovery from the bad setbacks suffered in the 1969 to 1970. In the past, such recoveries have ushered in the new stage of the recurrent and persistent bull market that began in 1949. This was the expectation of the Wall Street generally during 1971. After the terrible experience suffered by the public buyers of the low-grade common stock offering in the 1968 to 1970 cycle, it is too early in the 1971 for another twirl of the new issue merry-go-round. Hence, the dependable sign of the immediate danger in the market is lacking now, as it was at the 892 level of the DJIA in November 1964. Considered in our previous edition, technically, then the outlook would appear to favor another exceptional rise far beyond the 900 DJIA level before the next serious setback or collapse. But we cannot quite leave the matter there, as perhaps we should. To us, the early 1971 market disregard the harrowing experience of less than a year before disquieting sign. Such heedlessness can go unpunished. We think the investor must be prepared for a difficult time ahead, perhaps in the form of the fairly quick replay of the 1969 to 1970 decline, or perhaps in the form of another bull market fling to be followed by the more catastrophic collapse. What course to follow? What? What course to follow? Turn back to what we said in the last edition, reproduced on the point on page 75. This our view at the same price level, say 900 for the DJIA in early 1972 as it was late in the 1964. And it is all for today. Thank you for watching and have a good day.